Hi, and welcome to the third quarter 2019 market update. My name is Doug Johnson. I'm the senior investment strategist here at HCM. We just want to take some time today to go over the firm's outlook for the markets in the third quarter and give a little bit of detail on what our current portfolio positioning and thinking currently is. So with that, let's go ahead and get started. A little housekeeping item to let everybody know. We do have a shorter version of this presentation posted to the website as well that will just really do an executive summary of the first two slides we're going to look at. So if you'd like a more, or should I say a less robust version of this presentation, please close this one out, go back to the website, and you can pull that up. If not, we're certainly glad that you have joined us for the longer version, and we hope that that you find some value in what we're going to present today. So, looking at kind of portfolio positioning right now, currently we remain at neutral target between equities and fixed income. Just as a slight refresher, we had reduced risk slightly back at the end of 2018. We've since increased that risk back to neutral at the beginning of the second quarter, and we remain there right now. Really, the belief is that with all of the fundamental things that we've seen in the economy and earnings not being so stellar, we still believe that global central banks are the kind of the headline right now, and their continued mission, so to speak, to maintain easy policy, either through guiding for more asset purchases, which would in effect keep interest rates low, or flat out reducing interest rates altogether. The Federal Reserve has been in the news pretty predominantly over the past month with the expectation that we're going to see a rate cut of 25 to 50 basis points here in the near future. So earnings growth for corporations remains somewhat subdued, though we think that's kind of taken a back burner right now to central bank policy and that belief that rates will stay low, which is kind of causing the market to drive a little higher, but it's also causing valuations to move up as well. So we think those are elevated, based on historical measures. But they're still off the extreme highs that we saw in 2018. We remain slightly overweight U.S. assets, as we think that the U.S. growth is going to be a little bit stronger than global growth. Plus, we think that the ongoing tariff issues are going to create a little bit larger headwind internationally, and up until recently, a very strong U.S. dollar has been a benefit to U.S. companies, though. The dollar has weakened slightly over the past week or two. On the fixed income side, not a whole lot has changed. Our duration in the portfolios is still right around the index level. So just as a quick refresher, duration is a fancy term that's used to describe the relationship between interest rate movements and prices for fixed income. So if you have a bond or a bond portfolio with a duration of 5 and interest rates move up 1%, that bond or bond fund will move down 5%. So basically when rates are scheduled to go up, you don't want a whole lot of duration in portfolio. Last year, we added a lot of shorter duration products to mitigate rising rates. 12 months later, we're kind of in the opposite situation where rates have been moving lower and duration has been a benefit for fixed income. So we've slowly taken some of the short duration positions out of the portfolio. We haven't taken them all out yet, but there's certainly more duration in our fixed income positions than there was 12 months ago. The yield curve, which is just the description of what the yield levels are on U.S. Treasuries at different maturities, going from 1, 2, 3, 5, 7, 10, 20, 30 years. That curve inversion, which basically means that the short end rates are higher than the longer end rates, has historically been a precursor to recession. But in this instance, it also, I think, is describing extreme dislocations that you're seeing in the fixed income market in light of kind of extreme monetary policy. So we're certainly keeping our eye on that. We still believe that high yield fixed income is somewhat expensive. Again, high yield is your more credit sensitive, growth oriented product. So with high yield bond yields as low as they are, we don't think there's a whole lot of upside there. But we do think there's a decent amount of downside if we were to run into some economic problems. Global growth forecasts, we think, as mentioned earlier, remain somewhat hampered by the uncertainty of the ongoing tariff issues. In the beginning of May, those negotiations broke down. We'd really seen progress towards getting a deal. And then at the beginning of May, it seems like kind of hit a wall in terms of making progress. So the tariff issues, I think, has kind of taken a back seat to central bank policy, but it's certainly still there. And I think whether or not a deal gets done in the near future is more uncertain right now than it was before. But any major news out of the U.S.-China tariff negotiations could drive markets either higher or lower, depending on what the outcome was. Inflation expectations continue to move lower, although we did have a pretty high CPI print that came out this morning. But again, 1 month is not enough to make a trend. And the trend that we've seen, and you'll see it a little bit later in this presentation, has certainly been moving lower. So we're really not too concerned about inflation at the moment. So what are the risks going forward? Well, we think, Q3 earnings growth comes in weaker than expected, even though, expectations are very low right now. Something that was really, really out of left field in terms of poor earnings could shake up the market a little bit. If belief were to wane in the ability for global central banks to support risk assets. So right now there's a lot of investor confidence that the Fed, the ECB, People's Bank of China, that all these organizations kind of have the markets back, that they're going to do what they need to do to make sure that things don't fall apart. For the most part, everything's worked out okay. But if investors start to question their ability to kind of prop things up, that could cause some problems. Anything out of the U.S.-China tariff negotiations, if that deteriorates further, we would certainly expect that to cause some volatility in the market. And we saw that happen pretty much over the whole month of May. And then we mentioned the brief inversion of the yield curve earlier and how that's historically preceded a recession. But the time frame on when that recession actually takes place is a little bit less accurate. So those are kind of the larger themes that we're looking at right now. So we have some slides that we can look at, maybe go into those in a little bit more detail. So the first one, this slide touches on kind of the progression of earnings estimates over time. And what you'll see is on the left side of this, the blue, the black, the red, the green lines, those are forecasts going back 5 years. The blue line's 2014, the black line's 2015, red is 2016, etc. And what you'll see here is a pretty common theme. You'll get very optimistic forecasts for earnings that will slowly and quietly get revised lower and lower and lower and lower and lower until finally they reach a point that companies are very easily able to beat. You get the warm and fuzzy headline of, hey, look, we beat earnings expectations. Equity prices move higher and everybody's happy. So on the far right, the teal and purple, that's 2020, 2019. So what you saw was a little bit of a different look to this. You started with lower expectations, but then you had kind of an increase. Analysts were optimistic that earnings growth was going to kind of get better or continue to be better. Then right at the end of last year, if you recall, we had the market sell off. You had earnings expectations then kind of take a nosedive. level off a little bit as we saw a recovery, spike back up with some optimism, and now they've kind of leveled off a little bit. So, what does this tell us? It tells us that, that earnings expectations haven't fallen off a cliff, so to speak, but they've certainly not had the acceleration that we saw at the beginning of 2019. So kind of stable earnings isn't necessarily a bad thing. I mean, projections for growth going forward are somewhat tepid already. So I don't know in this environment that we necessarily need gangbusters earnings growth to have equity prices move higher with monetary policy being such a important driver. But I think the one thing to pay attention to here is that if earnings go sideways and prices continue to move up, that will certainly weigh on valuations. And as valuations move higher, they won't necessarily be a prediction short term of what the market will do. But valuations have historically been very accurate in predicting longer term return projections. And when you're starting from levels of high valuations, the 5, 7, 10-year growth forecast, return forecasts for equities move lower and lower and lower. So that's certainly something to keep an eye on. So as we look at, not only corporate growth, but economic growth in a whole, this chart here comes from an organization called the CFNAI. So it's the Chicago Federal Reserve Bank. And what this line represents, it's a weighted average of about 85 existing monthly indicators. And they all measure some form of national economic activity. When the scores relative to the trend are positive, you'll see that blue line above the solid black line that's 0. So that would indicate above trend growth. Anything below that would be below trend growth. And the dotted line with a negative 0.7 has historically been the recession break point, so to speak. So you can see those vertical gray bars in this chart. Those all represent recessionary periods. And you'll notice the uncanny correlation between where those bars reside in reference to when that blue line has crossed over that dotted line at negative 0.7. So we are not quite at that level yet, but you can see from this that growth has certainly slowed down economically. And normally, along with weak earnings growth, you would think that in a normal econ 101 framework that would be cause for concern, and it wouldn't necessarily be conducive to a market that is making new all-time highs. But this isn't necessarily a normal market, and we'll kind of touch on why here in a minute. The other interesting thing with all this going on is volatility has pretty much disappeared. So the chart you're seeing here just shows the number of single stock return days of plus or minus 2% or more over a given year. So naturally, your eyes will gravitate to that 72 right in the middle. That was 2008. During the Great Recession, you had 72 days where the market was either up over 2% in a day or down over 2% in a day. So that's a lot of volatility. The average for this time period, going back to 2001, is about, or I'm sorry, back to 1950, is about 11 days. Last year, we had about 20. The year before, in 2017, we didn't have any. So that was kind of the polar opposites. You had extremely low in 2017, then you had above average last year, and now we're sitting at about 4 days. Which is a little bit below average. And with everything that's been going on, I think if you asked investors how many days we've had of significant volatility, I don't know that many of them would come up with 4. I think when I first saw this chart, I was actually shocked that we only had 4 days. Not only that, the days have been clustered around very specific themes, ones that you've heard us talk about before, and we're going to continue to talk about them. But 2 of them were at the very beginning of the year when we kind of were coming out of the bottoming process in and the significant drawdown we saw. So if we take those out, you've only had 2 days of 2% market movements. And when we look at the price chart of the S&P 500, we can kind of see exactly where those have been. So again, that first arrow on the bottom left, January 4th, you had the Fed change their rhetoric a little bit in their statement, and they became patient and on alert for signs of economic weakness. So rewind again to the end of last year, and you had in October, the Fed was, I don't want to say adamant because that's too strong of a word, but they were guiding to 3 to 4 rate hikes in 2019. And many of the investment banks, Goldman Sachs being one of them, guided for 4 rate hikes in 2019. You say that now, and it sounds almost crazy to think that because we've done a complete 180 there. But just the introduction of that language on January 4th was enough to kind of flip the market direction, so to speak. So that big dip, sharp reversal, those were 2 of the days that we've seen in terms of volatility. So fast forward to May 1st, that was kind of the first day you saw the U.S.-China tariff talks break down, which resulted in a really, really bad month of May, so to speak. And then we go all the way down. We hit June 4th, and then we get another kind of Fed update that said they would act appropriately to ensure the economy would continue expanding. The market interpreted that as we are going to cut rates, and we are going to cut rates soon. And since that point, it's been kind of a one-way ride up. This chart was printed on July 11th, and as I speak, I believe the S&P 500 has broken over 3,000 for the first time. So you get this kind of, again, we call it this bizarre juxtaposition between looking at economic fundamentals, seeing slow EPS growth, slow economic growth, inverted yield curves, everything that would normally pretend to be an environment that wouldn't be conducive to equities, but because things are so lackluster and we're seeing the potential of things getting worse, it's actually strengthening the resolve of central banks to go through with this aggressive monetary easing, and the market is now caught on to this. So you're seeing these very weird days where bad economic data drives stocks higher because it's this kind of reflexivity where bad news is good news because the good news is now the Fed can cut rates. And that's as simple as it is. And it sounds so illogical. But part of being an asset manager is recognizing these trends and trying to participate in them as they happen. And this is certainly a trend that we've seen now for the past decade, where central banks have eased policy, and it's been a tailwind for risk assets. So we want to make sure that we're continuing to participate in this as much as possible, realizing that there's certainly an end game to this at some point. So not only has the central bank policies affected equity prices, but they've also affected things in the fixed income arena as well. So the colored lines on this chart represent a few things. The orange line is going to be the rate on the 10-year Treasury bond. The green line is going to be the rate on the 2-year Treasury bond. The red line is going to be the spread between the 10-year and the 2-year Treasury bond, or as we've called it before, the yield curve shape. And then we're introducing a new one here, which is the blue line, which represents what's called the 10-year TIPS Treasury break-even rate. So it's just a market implied reading of what inflation is going to be. So you see the line going vertical from 2018, and what you're starting to see there is that all three, the blue, the green, and the orange line, were all moving higher. and they continued to go higher right until kind of the middle of that box that's outlined on the right. Um, and if you remember back to 2018, the expectations was that inflation was going up, and that the Fed was going to have to continue to raise rates to fight that off. Then you had the market correction, and then now you've got an extreme reversal of all these things. So you had the 10-year Treasury going from, I think, a high of 325 down to 2. The 2-year Treasury going from 3 to 187. So these are really, really big moves in the bond market. And then you've got inflation that was starting to move and hovering over 2%, now down to around 1.65. So the bond market is telling us that they believe that the Fed is going to be aggressive. Not only that, they also believe that there's not going to be a whole lot of growth going forward. Historically, the 10-year Treasury rate has been a proxy for GDP growth, and what it's telling you now is, GDP growth is going to be right around 2%. So if we continue to see fixed income rates moving lower in an aggressive manner, that could be a result of the Fed lowering rates, but it could also be a result of the market really becoming concerned that growth is going to slow to a stall point, and that a recession is going to be imminent. Like I said before, we don't really see the growth statistics or the economic statistics to warrant being worried about a recession, in the next month. But the time from, hey, we're not worried about a recession, to, oh, there is a recession here, can be fairly swift. So we're certainly keeping our eyes on all of these kind of data points here and trying to navigate them as best and efficiently as possible. And one last chart just to kind of show the madness of what central bank policy has created over the past decade. This chart you're seeing right now has a reading of almost $13 trillion. Okay, not with a B, but a T. $13 trillion of global bonds that have a negative yield. So you think of, normal bond pricing. You buy a 2-year bond with a rate of 2%, we'll call it. You're going to get 2% interest. What a negative yielding bond is, it's a bond that has a negative interest rate to it. So you're essentially paying for the belief that you're going to get your money back at some point. So it's almost an extreme way to look at things, and I don't think it's necessarily a crisis situation that people are looking and saying we need to own fixed income at any cost because the world's about to end. It could be some of that, but when you have these organizations who have unlimited funds and who have no price sensitivity at all, and who can continue to buy these bonds hand over fist in order to drive rates lower and lower with the hope that will stimulate growth, you end up with a situation like this that's just a complete distortion of the fixed income market, and is creating a lot of very unusual situations. So I think, of all of the things that we can point to and say, monetary policy has done some weird things, I think this is one of the charts that you look at and you just kind of shake your head at. So in conclusion, so what's next? I think that the easiest way that we can lay this out is in a bull and a bear case. So the bull case, what can drive equities higher? So we've talked about central banks ad nauseum, it seems, but additional central bank easing is probably going to continue to move equities higher. If you see a U.S.-China trade deal done that's got some significant portions of it, including some type of agreement around intellectual property, that could be a very important catalyst to kind of getting global growth moving back on track and kind of unfreezing the uncertainty around the global supply chain. Then you also have improved earnings outlook and growth. Can we move off those really low levels of expectations that we have and see companies beginning or continuing to grow their bottom line and maybe growing into some of these elevated valuations that we've seen? On the bear case, if you see a central bank surprise, I think that's the number one concern. So if the Fed were to come out in their July meeting and say, you know what, we know the market's pricing in 25 to 50 basis points of rate hikes. We don't really care. We see it another way. We're not hiking, or I'm sorry, we're not cutting rates. That could shake the market up quite a bit, in my opinion. If we start to see stronger inflation, inflation readings above 2 consistently would give the Fed some pause in cutting rates, and may even start the chatter of switching to a rate hike at some point in the future. I can't imagine they would move that quickly to flip-flop back to a rate hike. But if that inflation case starts to build, that will be introduced into the equation. Stronger than expected economic growth. Now, some of you may be thinking that's a typo, but just follow me here for a second. So again, what have we talked about over and over and over and over? Central banks. If you start to get economic growth that is strong across the board, the case for needing easier monetary policy to support things goes away. And that has been a major, major driver of risk assets. You can see very clearly that during the sell-off at the end of last year, a lot of that was driven by the fact that the expectations were for rates to continue to move higher. So right now, the rates are being used as a brake on the car that is supposedly the economy and the market, so to speak. So when rates are lowered, that brake goes off. When they go up, that brake comes on. So it's going to take a very, very, very long time, if ever, to normalize interest rates where they were 10 to 15 years ago. And to get to that point, there's probably going to be some pain along the way. So if we start to see really, really, really good economic growth coupled with inflation, while normally that would be a good thing, I think in this case, it could actually work against the market as the possibility for rate hikes is now back on the table. And then finally, if you get an escalation of the U.S.-China tariff negotiations, I would expect some short-term volatility out of that. And if you got a complete breakdown in negotiations and really increased nasty rhetoric between the two, I think that could certainly cause some problems. So in conclusion, if I haven't said it once, twice, 3 times, I'm going to say it again. Central banks have certainly reignited investor confidence and the belief that stocks can continue to move higher. So right now we're comfortable with our neutral positioning. As I said, we want to aim to participate in additional price appreciation that we may see to the end of the year. But again, we still feel there's too many unresolved risks in the marketplace to warrant any kind of overweight to equities right now. And on the flip side of that, if any of these bear cases do materialize, we would expect to see renewed volatility, and we would certainly take that time to reassess where our portfolio positions are at that time. So with that, I want to thank everybody for joining us today. I hope you found some value in the presentation. And as always, if you have any questions, comments, concerns about anything that you heard today, please reach out to myself or to your advisor, and we'd be happy to follow up on those and go into greater detail if needed. So with that, I want to thank everybody for joining us. And until next time, we'll see you then.